everyone, good morning and welcome to Power Breakfast. And in the Mumbai News Centre, I am Sonal Bhutra and with me is Nigel D'Souza. Good morning, Nigel.
Morning, Sonal. Let's hope that in fact, today we can see a bit of a fight back. Yesterday, the markets were in a bit of a tizzy. We'll talk about that and more. First up, running you through all the top stories early this morning. Wall Street kicks off 2019 on a positive note, but volatility continues to rule as Dow swings 400 points intraday. Growing evidence of global weakness in the economy keeps investors on the edge, and there seems to be no progress towards US shutdown, which is now in its 13th day.
Asian markets mixed as US futures pointed to another volatile session for Wall Street after Apple lowered its first quarter guidance and warned of weaker sales in China.
And oil prices surge following a big drop in Saudi Arabia's crude oil exports in December. Tighter supplies offset record output in the United States and Russia and weak economic data.
Two-wheelers are not luxury goods, says Hero Motors' Pawan Munjal. Calls for a cut in a GST rate from 28% to 18%. But Rajiv Bajaj begs to differ, says improving technology and products are more important than a GST cut.
The swap ratio for the merger of Dena-Vijaya and Bank of Baroda is out. 100 shares of Dena Bank will fetch 11 shares of Bank of Baroda, and 100 shares of Vijaya Bank will fetch just over 40 shares of Bank of Baroda. Well, in terms of the Asian markets early this morning, the Japanese index continues to remain shut, but otherwise, Asian markets, they're trading more or less mixed. Remember, US futures, they're indicating a dip after Apple lowered its first quarter guidance. So for starters, let's get some of those markets up for you on the screen. The Kospi should come up for you. That's sitting with a cut of around 0.2%. All these markets yesterday didn't have a very great trading session. The SGX Nifty as well should come up for you. That's indicating a bit of a bounce back after yesterday a sharp cut is what we saw. Asian markets, all of them trading in the red, but the SGX Nifty is indicating a mildly positive start. We'll have to keep an eye out on the Hang Seng because that'll, we'll get the initial rates in just a bit. But that ended yesterday with a cut of around 3%. So let's see whether or not there's any bounce back early this morning.
Well, let's talk about the US markets then. On Wall Street, US stocks kick off 2019 on a positive note in a volatile session as a rebound by oil prices and worries about softer global growth continue to weigh on sentiment. The Dow closed about 19 points higher after dropping nearly 400 points earlier in the day. The S&P 500 gained 0.1%, while the Nasdaq Composite climbed almost 0.5% higher. On the data front, the final reading of IHS Markit's US Purchasing Managers Index for December came in at 53.8 versus expectations of 53.9. CNBC's Julia Boorstin gets us a wrap of all the action on Wall Street.
After a dismal 2018, Wall Street kicked off the new year on Wednesday with more volatility and ultimately some modest gains. The Dow down nearly 400 points early on, ended 18 points higher. The Nasdaq up by 30. No major earnings reports for investors today, but there's lots of economic data, including a look at U.S. manufacturing last month, private sector hiring for December, jobless claims for last week, mortgage applications for the final 2 weeks of last year, and sales of cars, trucks, and SUVs for December and for all of 2018. The auto industry is on pace to top 17 million units sold for the fourth year in a row. Day 13 of that partial government shutdown, and it's swearing-in day for new members of Congress. Meantime, House and Senate lawmakers will convene today, trying to hammer out a funding deal and get 400,000 furloughed federal employees back on the job. It's a new pro golf season, and the PGA Tournament of Champions tees off today in Hawaii. And Sony's Escape Room opens in select theaters in major cities tonight ahead of tomorrow's nationwide release. Julia Boorstin, CNBC Business News, Los Angeles.
Okay, on that note, let's get in some global opinion coming in on the US markets and their view on them going forward.
Even if we don't have any earnings growth this year, this is a cheap market, especially. Look at interest rates. Oh my God, I hardly believe the 10-year at 265. No competition from fixed income. I think we can really have quite a good year in the stock market.
We've got a divergence here between the economic data, which the preponderance of which suggests the economy is doing well and the fundamentals still sound, and the markets, which are sending a much less upbeat message. And I think until we get some resolution of that conflict, the Fed, for example, is going to be, watching to see how that plays out. Markets are an important signal and also contributor to the economic outlook, but they're not the only ones. I think the fundamentals are still good, but I do think growth's going to be a little bit weaker. I don't think it was on a sustainable trajectory. Unemployment rate cannot continue to fall indefinitely, so that's going to be an important contributor.
Well, meanwhile, Dow futures, they're indicating a drop of around 300 points, while the S&P 500 as well, those futures indicating a drop of around 1%. This as tech shares, they've got a hit in after hours on a warning coming in from Apple. Now, the iPhone maker has lowered its Q1 guidance following weaker than expected iPhone sales and a weakening economy in China. In a letter to investors from CEO Tim Cook, Apple has lowered its revenue guidance to around $84 billion. That's down from the $89 to around $93 billion it had earlier previously projected. The company lowered its gross margins as well to around 38% from between 38 to around 38.5% odd.
If you look at our results, our shortfall is over 100% from iPhone, and it's primarily in Greater China. And so as we look at what's going on in China, it's clear that the economy began to slow there for the second half. And what I believe to be the case is the trade tensions between the United States and China put additional pressure on their economy. And so we saw, as the quarter went on, things like traffic in our retail stores, traffic in our channel partner stores, the reports of the smartphone industry contracting, particularly bad in November. I haven't seen the December number yet, but I would guess that would not be good either. And so that's what we've seen.
Well, let's move on. And as global growth slowdown concerns continue to weigh and there is a higher chance of no rate hikes by the Fed this year, CNBC's Steve Lisman takes a look at all the factors that are likely to affect the Fed's decision-making this year.
Let's take a look at two scenarios for 2019, the optimistic one and one that's not so quite optimistic here. I'm focusing on two forecasters out there, Morgan Stanley and Action Economics. Here's where we think we're going to end 2018 at 3.2%. Big slowdown here, forecast by Morgan Stanley down to 1.7, shave 1.5 points off GDP. Less so for Action Economics, 2.6%, still above trend. The big differences in the forecast amount to what happens to the consumer and what happens to business spending. So take a look at the consumer. Again, a much bigger slowdown for the consumer. They don't see a lot of extra help to the economy coming from either the tax cuts or from the better jobs and wages we've had. So they have the consumer going down to 2.2%, Action Economics 2.6%. Now look at this big difference right here in the outlook for business investment, which again linked very closely to the tax cuts. We think we're going to do 7 this year, more or less, give or take. 1.8 all the way down for Morgan Stanley, whereas Action sees more tax cuts, or the tax cuts continuing to give off. Here's a quote from Morgan Stanley's latest report. Though a growth correction does not mean recession for the economy, financial markets march to a different drummer and may respond like they are in recession. Another big difference between the two scenarios. Morgan looking for a much bigger drop-off in government spending than Action. Mike England in Action says he thinks the market has this wrong, that government spending will continue to help growth through the first half of 2019. Other factors we're looking for are those tweets, the trade war, and the government shutdown along with low oil prices. All of those have the ability to affect GDP as we go on. We'll have to measure that, and we start at one place, and we'll see what the ending is for the year.
Well, on that note, here's some more opinion coming in on the Fed's rate trajectory.
I'm not concerned about the Fed. With the 10-year at its level that we see now, we're not going to see any increases. If it's below 3%, I think the Fed is really going to defer. I actually think it was a mistake. I don't think they should have raised in December. But nonetheless, I think that we don't have to worry about Fed rate hikes as long as the economy is.
I don't think they have shrouded themselves in glory with their communication. I think at the Fed there tends to be a premium on precision of language as opposed to clarity of communication. I think what Jay is trying to say to markets, to the world, is if the economy is strong enough, we will keep hiking. But if there's weakness, we're not going to put our heads in the sand. And I think people are missing that. They're only hearing the first part, which is we see strength in the economy, and as a result, if it stays strong, we'll keep hiking. But I don't think they're so clueless as to hike into a soft end.
Well, turning attention to the European markets, major markets out there, they closed mixed in the first trading session of 2019 after weak manufacturing data fueled concerns about a global economic slowdown. The DAX and the FTSE, both of them closed in the green yesterday, while the CAC ended with a cut of nearly around 0.8 to 0.9%. Now, the Eurozone data also disappointed, with the IHS Markets December final manufacturing PMI reading that came in at 51.4. That's down from 51.8 that is recorded in its previous month. Well, however, the manufacturing output PMI, that came in at around 51. That's higher than November's reading of around 50.7. So that's about the European markets, but keep an eye out on the emerging markets as well. In yesterday's trading session, the Brazilian index, that was up and about. That ended with a gain of around 3.5%, and we're talking about a meltdown globally. That market's moving to almost the highest point we've seen in the last few years.
Well, let's move on and talk about the commodities market then. Crude oil prices rise, bolstered by signs of tighter supplies from Saudi Arabia. Remember, January marks the beginning of OPEC's agreement with 10 other oil-producing nations, including Russia, to cut production by 1.2 million barrels per day.
And from the precious metal space, gold trades around its highest levels in over 6 months as weak factory activity data in Europe and Asia compounded concerns of a global economic slowdown. That's what weighed on stock markets, and that's what's increasing demand for safe haven like gold.
Well, it's time for a break now. All the cues and news you need to watch out for trade this morning.